Hello, everyone. On today's episode, common sense spending rules. Wait, scratch that. We don't like rules. Let's think of it more like guidelines. Common sense spending guidelines for housing in uncertain times. Welcome to the ultimate crowdsourced personal finance show. This is ChooseFI.
You're listening to ChooseFI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. ChooseFI, your home for financial independence online.
All right, guys, very excited to dive into this week's episode. And help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, in fact, I might be sounding quite well. You actually got me a new microphone here. I finally relented and let you come over and install a new microphone. So I'm getting used to it a little bit. It takes a little different mic technique, but I think it sounds pretty clear, at least to your ears, right?
Yeah, you'll never know because you refuse to listen to the sound of your own voice. That was like part of the thing that kept me from doing the thing, is that we've always worked around Brad's idiosyncrasy. Oh my goodness, this word. Why do I try these words live? Idiosyncrasies? There we go. Yeah.
I have more idiosyncrasies than one could imagine, and that is certainly one of them.
You've got a couple for sure. So we went over to the Brad Cave yesterday and we updated a few things, and it sounds really good, man. I know, like with the last couple of months, for whatever reason, the mic that we were using, it just kind of felt like it was peaking a little bit, or it was, it just crackling here and there. And we were trying to figure out what those updates would look like. So thanks for letting me come over and make those adjustments. You sound great.
Thank you. Hopefully I'll keep on rocking and rolling over here, talking into the mic clearly. So thanks for everybody out there putting up with me here. But yeah, Jonathan, what's going on in your world?
Well, it's kind of tied to this episode, actually. It's not directly correlated, but I would say it's a nice coincidence. I just had to deal with my Globo Bank over a insufficient fund situation.
Oh, wow.
Yeah, I'm really setting myself up here. So
this is like the Jonathan foibles on the podcast. The ransomware last week, now the insufficient funds.
I wish there weren't so many of them. Like, dude, could you just get it together? We're like listening to you occasionally for bits of wisdom and advice, but you keep screwing. I know. Anyways.
But that's part of it. I mean, that's fair though, right? Like that's part of it is we all make mistakes. That's for damn sure. Even people who think about this all the time. So
that's right.
I'm interested in hearing what happened, obviously.
Yeah. So in this case, I just outsmarted myself a little bit. So Danny and I have been talking about making extra payments on our mortgage, just paying down our mortgage early. And the impetus for that was that recently we were solicited with a letter talking to us about a great rate. This is recent, but at the same point, that's long gone. Those offers are long gone. So
okay.
But at this particular point in time, it was a chance to reduce it. I think we're already at like a 3.35 or a 3.15. We have a good rate. I'm very happy with the rate that we locked in. Okay. But this was an offer that suggested that it could drop at another couple points. We looked into it.
Couple of points?
Well, okay. Yeah. A couple of basis points.
Okay.
A couple of basis points, right? So it would have been about, in theory, based on the letter, it would have been about a 0.5 percentage point drop. But then when we looked into the details, there were so many additional changes that you would have to make and fees that you would have to pay. I just came to the conclusion, it's just not worth the hassle. If we just make a couple extra payments a year, we will do better than this quote unquote dramatic change in rate. And to out earn that, to really make all the extra inputs that we'd have to put in, the money we'd have to pay up front to get this better rate, we'd have to be in this house for about 5 to 10 years before the extra money that we would have paid would have covered the fees that we had to do to adjust, said rate. So with all of that being the background, Danny and I had a conversation around just making a couple extra payments a year on our mortgage. And just, Brad, as you know, like, that has a dramatic effect on the total interest paid over the lifetime of the loan.
Yeah, no, it certainly does. Almost shocking amount. So hold on, I want to just slow down for a second because I sense this story, there's a lot of meat here. So, okay, you got solicited by a company just for a simple refinance, but it was loaded with fees. Sure, the interest rate was better, but you're saying it was loaded with fees. So it really didn't make sense. As I understand it, you currently have a 30-year fixed rate mortgage at a little over, I think, actually, I might know your percentage better than you. I think it's 3.25% is yours, because I'm pretty sure we refied from the same company at around the same time. And I got an eighth higher. I got a worse interest rate because I was like
sitting on your shoulders for years.
Yeah. I will never forget that as long as I live. So yeah, I think you're at 3.25%. So, okay. So, right. So that leads us to today. So that was the impetus for a conversation between you and your wife of, oh, interesting. What do we want to do, if anything, different than just paying this off the standard 30 years?
Right, exactly. Thank you. So once we agreed that we were going to follow this course of action instead, just make a couple extra payments, then we were now ready to make that extra payment. And so I went into Globobank's system to set up the extra payment and set up my double payment. And I was, very happy with myself until I discovered a couple weeks later that the double payment had not been instead of my regular payment. Globobank had made it in addition to my regular payment. So 3 payments, 3 monthly mortgage payments, where normally it'd be 1. I was expecting 2, not expecting 3. And I'm discovering this just after it happens. And suddenly I'm encountering an insufficient fee scenario. I try to jump in front of this. And I'm like, oh, I can see where this is going. I can see insufficient fees are coming my way. What does this mean in terms of my credit, that a mortgage payment hasn't been made? So as it happens, Globobank also is my mortgage holder. So you would think maybe you would just call one department. Well, you would think that for half a second, unless you've lived the last 10 years. So those 2 departments could be in 2 different countries. They definitely are going to have separate phone numbers. So, it's multiple phone calls later. And at some point I'm talking with a customer service agent and I'm asking, well, look, we do a lot of business. I have my mortgage with you guys. I have my bank with you guys. I have, a pretty decent amount of assets with you guys. I would consider it a nice gesture if you would just waive the fee, to which the customer service agent said, well, actually, I'm sorry, sir, that's a system generated fee and I can't waive the system. To which, I always really like to respond in a very positive, forward-looking manner with customer service reps. But my knee-jerk reaction was, you are the system. Right. You created the system. Of course you can waive the fee. It's your system. Do I think an individual person is going in and choosing to punish me with a fee? Of course it's a system generated fee. Can you waive it? We could go to the conclusion of the story in a second, but I just thought I would pause. Wow. Because of course it's a system generated fee.
Yes, obviously system generated, which, that doesn't preclude them from being able to manually override it, right? So, so that makes sense. But okay, hold on. Because, I want to slow down and just ask the pertinent question. So when you said you made a double payment, now that sounds, and I'm trying to determine what exactly mechanically happened here, because I think this is going to be useful for people who are thinking about paying extra on their mortgage, right? So I've always heard that you pay an additional amount specifically to principal. So you're making an additional principal payment. You're not making a full second payment of your mortgage, which to me, that always sounded, and I've heard kind of horror stories of oh, you think you're paying down principal. You think you're making an additional payment, but you're in essence just prepaying your next month's mortgage, and they just kind of count it a month later or some such, obviously I probably have the details wrong. This is a game of telephone, but it always sounded more akin to that than, okay, I'm sending in my regular mortgage payment and then I'm sending in a specific amount, $500 extra to principal, which just it's on a separate line. It's kind of foolproof. It just gets lopped off of principal. And that's when you run through the amortization schedule of, oh, how does this get paid off if I pay a couple $100 extra? That's usually what it looks like. But with the way you're describing it, it sounds like you were trying to make a full extra payment and then they did choose somehow. So that suggests to me that it's okay, I'm also paying my escrow double or triple in this case, et cetera. So it sounds slightly different. Do you recollect what you clicked or anything?
Yeah, I mean, obviously this is going to vary from one Globobank interface to another. But I think I wish I had slowed down a little bit to look and see it was a big transaction. I know that in terms of double payment, I was very explicitly trying to map out, how much is my mortgage? Well, I'm going to make an additional payment of that exact amount. I don't think I was selecting the option that said double payment
Okay, good. And I wouldn't think there would be one necessarily.
I'm pretty sure I filled in the box that said additional principal, but something went off the rails. And I'd have to go do some forensics to see why the amount that I selected was not just added to my regular payment, why it was a separate transaction entirely, and then why it ended up being effectively 3 transactions. Something went off the rails. And this is why I was a little frustrated going into the call, because I feel like at the end of the day, absolutely, the extra money just went to principal. I'm convinced of that. I'm not saying that they're double claiming the escrow. This is not a complaint about that end. Yeah. It is a little bit interesting to me that it went the way that it did and another payment tried to be withdrawn. So, I wish I could break that down more for you. I would just say, like, not the theme of today's episode, but to individuals that are making extra payments, just pay attention to the nuance of whether you're scheduling an additional payment, whether you're scheduling additional principal. What is that going to mean in terms of the payment that was already scheduled? When will your next payment be due? There's probably, if you're paying extra money, it's probably worth spending a little bit more time before you press the submit button, because I am pretty sure at the end of the day that there was something else I could have done that would have prevented this. Like, I can't imagine they're intentionally creating these scenarios to have, all these customer service interactions have to be required.
I mean, right. They want their fees as much as the next company, obviously, maybe more so. But yeah, I doubt they specifically set up the user interface to mess with you. But this does actually bring up, so, okay, you're in a scenario where now you, at least as I'm hearing you had some extra money lying around in your checking account. You and your wife very explicitly made the decision, hey, we want to pay some extra to principal. And obviously paying one extra payment to principal wasn't going to run your checking account down to 0, but it sounds like paying 2, this inadvertent thing, ran it into the negative, right? Because you got to insufficient funds. So now, okay, this obviously isn't the prototypical FI story here, but this happens to people. This happens to people in our audience. Like, you're at a point now where your checking account is essentially overdrawn. Like, what do you do in that scenario? Like, do you have to sell investments to transfer money? Because then what if, the electric bill comes through or the cable bill comes through that's $100, but then you're dinged for more money? Like, I mean, this really is a larger issue that's really important.
Yeah. I think one of the things is that I use various buckets, and I have a bill pay bucket, and I would never keep $10,000, $20,000. I guess maybe there have been times where there's $10,000 in there, but I'm not going to have a scenario where there's going to be $30,000, $40,000, $50,000 sitting in a checking account. That's just not an efficient use of resources. It's not what, I would do. So I keep some amount triaged for bills. And in this case, it was more just of a timing issue and that sort of thing. So I could easily resolve the insufficient fund or the balance. It's just based on calculations and how much you think you're going to need. But the larger point was like, hey, avoid the fees, right? Like in this case, regardless of your planning, something's gone wrong. And while you could put more money in and you can cover it, like, you've now potentially gone down a path that is going to have some sort of fee that he hits. And what happens if, like, they try to bill it one day, it's not there. They try to bill it the next day, it's not there. Overdraft fees are a $2+ billion a year banking industry. Like, that has been the standard practice for the last 20 years. I remember as a high schooler, when my average balance was around like $100, $200, something like that. And, you're learning how to use money and you have a couple overdraft fees and suddenly $30 disappears. Your annual income was less than $2,000. And now,
that's a material difference. Yeah.
So a great life practice is avoid the fees, right? And so while you want to avoid them first and foremost, if you know that it's coming, you can call and get in front of it. And this is something people don't realize, but a lot of times banks, if you call them and explain a situation, they even have it built into it that they can waive a fee, this sort of thing. So if it were to happen, you can do that. So I proactively got on the phone to call them and try to look into it. Hey, is my credit going to be dinged? Like, I was technically paid ahead, but now a payment hasn't gone through. What are the implications? When is this payment going to go through? And then third, what about this fee that I know must be coming? And so after this conversation with this customer service rep about the system generated fee, I was like, well, can we escalate this? I think I need to talk to a manager. And so we escalated. And actually the manager explained to me, and this was something I hadn't captured in the first conversation, that this particular Globo bank actually doesn't charge insufficient fees anymore. So that was not what was being described to me. They have let go of insufficient. They're not doing that. And I was like, wow, well, that's incredible. Seriously. So there is not going to be insufficient fee. And so the fee that was going to be charged was going to be if we needed to do like a stop payment fee, if we needed to tell the other company not to do it, they were going to have to charge this fee for that service, which in my mind is completely different. So we worked something out. That's all fine. And I don't want this anecdote to take longer than everybody needs. But the big takeaway is, when you're trying to be clever with your buckets, pay attention. These fees can add up if your bank charges them. If your bank does hit you with an insufficient fee, be nice. Hop on the phone with the customer service rep. You can probably get it waived, or maybe you'll find out that your bank doesn't charge you one, which I found out in my scenario.
Well, and I think that last piece there is probably the biggest life lesson that you can take away from this whole thing, and from a lot of even our show, is like, be nice, be a human. And that, with the intersection of everything is negotiable, right? That's something we've talked about so many times here. You have to think about, you're speaking to a human being when you're speaking to a customer service rep, right? And if you get on and you're in a huff and you're mean, just think about human nature. Do they want to help you? No. I mean, think about, how can you interact with somebody who's probably dealing with 95 mean calls for every 1 or 2 nice calls? So I think it's just like even if you just wanted to look at it from like a horribly Machiavellian standpoint and just say like, okay, what's the best strategy just to further my goals? Just being a nice person is the best strategy to further your goals. Obviously, I hope you're a nice person just for the sake of being a nice person. But even if you aren't, clearly, like Jonathan, we've seen it over and over again. Just being nice and just asking for what you want. How can we work together? How can we, just in general, like these thought processes of, how can this be a win-win?
Yeah.
Right. And we've seen that over and over again. And it's funny, actually, this just the last piece, it reminds me of one piece of feedback we've gotten that I haven't even told you about, is the IRS abatement letter, the tax penalty abatement letter that we talked about on the podcast, very much in passing in a tax episode a couple months ago. I've gotten more emails about that. People successfully getting rid of penalties, just requesting tax penalty abatements, than virtually anything we've talked about on the podcast. It's amazing. And like that, for anybody, you should go back and listen to that. I could get the episode number at some point here. But essentially, and again, this is not financial or tax advice. Obviously, this is not foolproof. But in my experience with taxation authorities, obviously you have to pay the tax that's due. Like, let's say you get a notice, right? And you just made a mistake in your return. You owe the additional tax, and that's fine. You have to pay the interest. There's no way out of that. But if there's a penalty on there, you should always send a nice letter, nicely worded letter, requesting what's known as an abatement, which is just a fancy way of saying, please get rid of this penalty. And you just explain like, hey, this is the first time this ever happened to me. I made this mistake. I've always paid my tax on time in the past, and I have taken great care to assure you that nothing like this will happen in the future. And I mean, in my experience, Jonathan, as being a CPA, that works 95% of the cases or more. So there's no downside. That's the good thing about, again, not tax advice, but every penalty that I can think of does not continue to accrue once you've paid your tax. So there's no downside in requesting that. It's not like it will continue to accrue. So just a cool little, everything's negotiable, and just be a nice person. So the intersection of that.
Right. So we're into a new tax season right now. So you probably have a little time before you're worrying about this, but to close the loop on that, it was episode 372. You can go to ChooseFI.com/372. Title of the episode, Can I Get an Extension, Please?
Right. Thank you, Jonathan. And even though it is a new tax season for 2022, think about it, 2021 notices might be coming out now, right? Because people just filed their returns. Notices might be coming out with penalties. So hopefully this is timely for some people listening.
I actually noticed on TurboTax, the functionality there, they make it very easy for you to include that request actually in the TurboTax software to people as well. So I know It's kind of like, well, who do I send this to? Well, your actual TurboTax software now allows you to put a message in there if you want to request penalty and abate. It's super, super simple and easy. So, the same way you're like, is this going to go where it needs to go? Just keep that in mind. That could really be an additional tip for individuals. So, title of the episode, Common Sense Spending Rules. And today we're talking about housing. Now, one of the things that's so interesting is, though, Brad and I were gloating just 10 minutes ago about the interest rate that we locked in, over the last couple of years. Interest rates for the last 3 or 4 years have been insanely low, and it's been a race to the bottom. That race is now over. And the bottom has fallen out or turned into a mountain, and interest rates are back up nearly 2%. In fact, I was just looking, and as of today, the average mortgage rate was showing well over 5%, 5.3, 5.4%. Now, your rates may vary based on locale, but it's interesting to note that at the highest level, the generic quotes that we're seeing out there from various mortgage lenders, that's what they're coming back with. And that poses some very interesting circumstances. It kind of will give us some data about maybe what's going to happen in terms of home prices, but also it speaks to how much home we can actually as individuals afford if you're trying to get into your first home or if you're selling one home and moving to another. And we thought it might be an interesting opportunity for us to just take a step back and just, forget the actual interest rate, forget anything else. Let's just talk about some guidelines, some common sense guidelines that we can use to give us a sense for how much home or what sort of payment we can really afford with this goal of financial independence in mind. And so, Brad, I know there's a bunch of stuff out there, but I thought it'd be nice to kind of bring it into this conversation and fold it into maybe some other ideas we've had around savings rate and financial independence goals.
Yeah, I love that, Jonathan. And I think, we can try to build out almost like a budget or income statement for somebody pursuing FI, right? At different levels of income, single, married, filing, joint, et cetera. And I love this. As we're saying, these are not spending rules because nothing we talk about here, there's no hard and fast rule on the path to FI. There's no hard and fast rule as far as we're concerned in personal finance. There are guidelines. Obviously, you have to figure out what works for your life. And we believe clearly that a higher savings rate will get you to financial independence quicker. And we think that that is a wonderful life goal. That's what I think personally. But obviously, everybody needs to figure out what works for them. So I think it's important just to have a sense. We talked, Jonathan, about different savings rates, right? Like 30, 50, 70%. Like, okay, what does that look like in practice? Especially when you're talking about your largest expenses, and of which housing is the number one expense for the vast majority of people. So, okay, what does it look like if you're making X income? What realistically can you spend per month on housing, either your mortgage and all in or your rent, and still have a chance of saving X percent, right? Like that is an interesting exercise as far as I'm concerned. So I'm very, very excited to go through this. I wanted to mention just really quickly in passing, I just pulled this up, Jonathan. So obviously I have my FI weekly newsletter that we've talked about here on the podcast. So I send this out, I handwrite it on Mondays, every Monday. It goes out Tuesday morning. You can get on at ChooseFI.com/subscribe. And on April the 5th of 2022, so just like 2 months ago, I actually had a little segment in here about mortgage payments and the impact of rising interest rates. So since you mentioned this in passing, I'm going to take 30 seconds here, Jonathan, just talk about it. So I basically tried to contrast. I looked at monthly payment and this is almost like a science experiment, assuming all else was equal, right? Which is not reasonable in the world. But if you change one variable, that's all I was doing. I'm not implying anything further about the world, how people would respond, et cetera, just simply one variable changing. So a $300,000 loan, I said with the old school interest rate, which actually I have 3.375% on a 30-year loan, it would have produced a $1,326 monthly payment. So that's on a $300,000 loan at 3 3/8 for 30 years. Okay. Now, interestingly, a $300,000 loan at 5%. So Jonathan, I lowballed it based on what it is today, but if 5% sounded reasonable 2 months ago, that would have jumped up almost $300 a month. So it would have jumped up to $1,620. But I think the better comparison is to get back down to, because most people are managing their monthly payments, right? So if it was $1,326 per month at 3.375%, and again, the $300,000 loan, let's assume they put 0% down, right, on their house. The house costs $300,000. Well, with 5% interest, that house is then only worth $247,000 because that person is managing that $1,326 monthly payment, again, at that 5% interest. So that's a $53,000 drop in basically what somebody could afford to pay per month on that $53,000 in total house value or principal of the mortgage. So it just shows, again, that's but one example, but it shows how significant that interest rate increase can be in terms of what does this mean? Again, when you're just changing this one variable, I understand that's not the real world, but this is very directionally accurate.
What's so interesting is thinking about the macroeconomics of this, and you hear about conversations around how interest rates need to increase to fight inflation. And if we want to have inflation go back down, and actually you're seeing what you just described is really the crux of that. So we have housing costs seem to be going up for various reasons. All right. But if you increase the interest rates, then the amount of people that can pay more for a house go down, which decreases demand for house, which drives the prices of houses back down, right? That's the internal conflict between those two and how they relate to each other. And just we're seeing interest rates go up to combat inflation. And then you're like, oh, well, now that's affecting me and my personal wallet. Oh, ouch.
Yeah, no, it's all an interplay. It obviously is. And yeah, we're not prognosticating that housing prices are going to go down necessarily. It's just, again, with that one variable change, if you take that as the only thing and you assume that people are maximizing their monthly payment, then by definition, housing prices would have to go down. I understand that's not how the real world works. But again, it's an interesting exercise to look at.
Can you imagine if you could just invest based around a one-factor thesis? Like the world is so complicated and there's so many multivariables. And we'll come back. I think there's another final point. We can come back to that in a little bit. But it is kind of interesting to talk about the dynamics between the two. So it really tees us up. Episodes like this are challenging to put together because there's a lot of data to bring in to kind of inform what comes out of this. And so it's not like we can't do this type of episode every single week. But when you do, much like when we did the savings rate episode, they kind of inform or give you more information about the financial choices that you've made up to this particular point. And so one thing that I always find very interesting is people know what they make, but they don't necessarily know what they actually bring home and have to spend. So people can tell you like how much their income is, but they don't really, they couldn't necessarily tell you what their after-tax income is. They just don't have that data as easily ready to go. So for instance, we kind of ran these numbers for a couple different scenarios to come up with some like spending guidelines at different income brackets. And we worked through $50,000, $75,000, $100,000, $125,000, and $150,000 of annual gross income. But for each one of those, that's the top line. What is your after-tax income? Now, obviously, already that's become more complicated because you have to then account for, well, is this person filing their taxes single? Are they, filing joint? Are they saving in pre-tax accounts? So we have to make an insane number of assumptions, but just kind of working through these categories at the highest level, it's important just to recognize that your top line gross income is not what you have available to spend. And so as a simple example, if you're making $50,000 a year and you file single, then your take-home pay on that gross income, assuming you're not saving anything in any sort of pre-tax bucket, so we can come back to these assumptions, but would be $38,000. $38,000 a year. And there's a bunch of assumptions in that. What state do you live in? What's your local tax? Et cetera. Virginia is just kind of like a run-of-the-mill state in terms of state taxes. And that is kind of working as an average point for us just to focus on. But you can imagine that some states have a lot higher and some states potentially have none or a lot lower.
Yeah, agreed. And so, right. So this is not saying by definition, if you make $50,000, you are 100% of the time taking home $38,000 after taxes. That's not the way the world works. But Jonathan, you use an assumption for Virginia. And what was the software again that you used?
I absolutely love smartasset.com. It is better than TurboTax. It is by miles the absolute best tax projection. If you just want to base it on a few simple assumptions and you just want to quickly grab it, smartasset.com. And then it's right there on the top nav bar. It's called taxes, but you can also go to smartasset.com/taxes and then select income tax calculator. And I use that for nearly all of these types of projections. And you can actually get these numbers based on your state, on your zip code. So you can get your local taxes incorporated as well. It's phenomenal. I'm jealous of the API they have on the back end.
Yeah, I've seen you use that more times than I could count. So yeah, clearly if you're following along here, listening to this and want to do something similar for you based on where you live, just go to that website. And that's what Jonathan used for this, just based on Virginia.
Now, if you were married filing joint. In this case, on that same income, $50,000, you would have, after-tax income would be $40,897. So it's about an extra $2,000 of take-home pay, $2,500 in take-home pay. And we can keep working our way down. Someone that says, hey, I make $75,000 a year, married filing joint, your actual take-home pay, after-tax take-home pay, would be $58,500. All right. Now, all of these are fine. And I could do this again for 100, 125, 150. If you're making $100,000 married filing joint, then your take-home pay would be around $76,000. All right. And it keeps scaling up for there. But if you make 100, that doesn't mean you have 100 to spend. And if you make 76, that doesn't mean that you have $76,000 to spend every month. Right? I mean, this is the next thing. Like what we actually, in terms of making our monthly spending decisions, we need to then translate that to monthly income. This sounds like common sense, but like a lot of us just don't really think about our finances this way and then make huge financial decisions around those concrete numbers. So in the case of someone making, $100,000 a year, they're filing, married filing joint, their after-tax income is $76,000 a year. Their actual monthly spending, their monthly income that's available to spend or save or do with what they want is $6,349. And that's the type of number that we need to get to when we're coming up with some sort of, common sense spending guideline, whether we're talking about what we can afford to spend on a car, what we can afford to spend on a house, or everything else. That's the actual number that we need to get to.
Yeah. So that is a great place to start, I think, right? That married filing joint, $100,000 gross income. Okay, you figured out after taxes, they're bringing home about $76,000 or $6,300 a month. Where would you start? Again, these are just guidelines. We're spitballing here, trying to figure out okay, somebody pursuing the path to FI, what does this look like, right? And you also have to take in mind, you're going to get very different advice based on incentives, which drive people's behavior. So if you ask your mortgage loan counselor or your real estate agent, you're going to probably get a higher percentage of, hey, what can I afford, quote unquote, for my house? So you have to keep that in mind. You can afford, again, I say that in quotes, more if you're willing to spend every dollar you have and have a 0% savings rate and being house poor. And I think you could afford an amount, but it depends what your starting place is. Is your starting place just absolute guaranteed, I need a 20% savings rate, I need a 30%? You could start from there. That's what's cool about an exercise like this is, Jonathan, there's no right place to start. It depends how you look at your budget, et cetera. But for me, how we always thought about this, how my wife Laura and I always thought about it was, okay, yes, there's an amount we can afford based on just the pure dollars coming in the door every month. But that doesn't take into account emergencies or life is lumpy, as we call it, or saving for travel or kids or 529s or retirement or anything. There was an amount that if we spent every dollar, we would be fine if nothing went wrong. But that's not how I want to live my life. I want to live my life based on a savings rate because I want to reach financial independence. So that's why I always took it as complete junk, what people said I can afford. And I looked at my own life based on my own circumstances and goals, most importantly, and said, oh, this is a very different number.
Right. So our community starts with what are our goals? And then the line items, especially the large structural expenses, should then support those goals. We don't want to live in a cardboard house, but at the same point, our goal is not to be in the biggest house that we can afford. Our goal is to get to the point where working is optional and reclaim as much of our time as possible in the process. The marginal utility of a fork. That was a concept that was thrown at us a long time ago by the happy philosopher. And we can get a plastic utensil. We could get a generic steel fork. We could get a decorated steel fork, or we could get a fork made out of gold. Ultimately, the fork's goal is to get food from our plate to our mouth. And while we might not choose to go plastic for various reasons, we also probably don't need to go gold if our goal is to have a way to take food off our plate and put it into our mouths. The marginal utility of a fork, but that same idea should translate to these larger decisions as well. And so with that, you really need to appreciate that framework in order to then appreciate the rest of this conversation, because there are absolutely people that do not have this goal of financial independence. It's not something they're thinking about. It's not something they want. It's not something they're striving for. Their goal is just to get a house they can afford, and that would change. That's going to change how you look at this framework. But assuming you have goals beyond just being in a house, the biggest house that you can afford, this will kind of show you why some of these spending rules, these spending guidelines are kind of useful as a place to start.
Hey, this is Andrew from the ChooseFI team. I hope you're enjoying the show. We're going to get right back to it after these quick messages.
So there's a common rule in the mortgage space called the 28% rule. And it basically says that you should spend 28% or less of your monthly gross income on your mortgage payment. So we're going to dive into that a little bit further, but I think this is an interesting place to point out that your mortgage payment is more than just you making payments on your home and paying down the total cost. Your mortgage payment has to include, yes, the actual cost of the house. It also needs to account for the interest rate on the home. It also needs to account for the property taxes on the home and the homeowner's insurance, and depending on what sort of down payment you put down, the property mortgage insurance. All right. So when we talk about a mortgage payment, there's actually a lot of things that are encompassed in there. And so, as we talk about a mortgage payment, that isn't like one-to-one, take the mortgage, at $300,000, divide by 30 years, divide by 12, that's your monthly, there's a lot more that's factored into that mortgage payment. So when we talk about these interest rates going up, that's got to be factored in. As Brad was started the conversation, that's going to have a huge impact. And so what we thought we would do is instead really focus on what we have to spend, what we can make choices around that after-tax income. For these purposes, we are disregarding how much money we could put into a 401k. We're going to come back to that decision at the end, and that will then inform a little bit more. But for these purposes, we have this whole pie, which is our after-tax income. And now we're making a big choice, a 30-year choice around how much of that after-tax monthly income do we want to go to the mortgage.
Yeah, and just a point of clarification. So you said that the standard rule of thumb from realtors and mortgage brokers is 28% of gross monthly income. Is that right?
Gross monthly income. That's correct.
So, right, that's not after-tax money. So that would mean somebody a married filing joint, married couple making $100,000, their gross monthly income is $8,333, right? Just simply divided by 12. And when you multiply that by 28%, that would be $2,333 per month on mortgage or rent or whatever it may be. So we should, Jonathan, keep that in the back of our mind as like an anchor point of 2,333 is that standard advice for somebody making $100,000.
Yeah, Brad, that's a great point. The 28% rule in this case is something that mortgage and mortgage lenders, they're going to be aware of. It's easy for them to actually assess, and they don't necessarily know how much you're putting in your 401k. It's just a top line measurement. You can show them, here's my gross income, and they could say, all right, you're likely going to be able to pay off your loan and not be delinquent. Not going to have to foreclose on you, or you're not going to fall behind if you're at this amount. But their interest, generally are just to make sure that their loan is paid plus interest and that their loans are healthy. Their goals are not necessarily your goals. I do think that 28% is reasonable. I would probably personally be a little bit more conservative. We were kind of looking at this from like a range perspective and thinking about this in terms of not your gross pay, which is less relevant, but how much you actually have available to spend after taxes, and thinking about this as a continuum between spending somewhere between 25% to 35% of your after-tax income. After looking through some of the numbers that we're going to talk about, it becomes pretty clear that if you're at that upper end of 35%, your other goals are going to have to fall by the wayside. But it kind of depends on where you are on the income spectrum. Some expenses are not directly tied to income. Like there's a threshold. Food is not going to cost an infinite amount. If you're a family of four, there is going to be some minimum threshold you're always going to be at. But, if you're making 100,000 or you're making 800,000, it's not directly tied to your income. It's probably going to be relatively the same. But having said that, if you're a family of four and you're making $50,000, it is a much higher percentage of your income, but you're also not going to be able to get it down to zero. unless you're growing all your food in your backyard. These are the types of things that you have to account for. So for most of us, there is going to be a minimum threshold of spending, and then at which point we have more income available for discretionary spending. All of that being said, kind of as a starting place, the rule of thumb that, after running these numbers, I felt pretty comfortable with personally, and I'll get your input as well, was 25% of your after-tax income should allow you to accomplish most of your other goals, assuming that your other debts are not out of control. So if you have massive other structural debt-based expensive, massive student loans, massive car payments, maybe multiple, it's like all this could fall apart. But for most people, their biggest debt is their mortgage. Maybe they have one car payment or less. Like a 25% of your after-tax income should allow you to be well on your path to financial independence at the same time. And we can justify that at, various income levels by going through a budget exercise, Brad.
Yeah, agreed. And like you said, it's important to note that obviously there are structural expenses that don't go up dramatically when you make more income. So clearly you're going to have a higher savings rate, all things equal, if you make more money, right? Because a lot of this stuff, like your cell phone doesn't cost more per month if you make 70,000 or 300,000. So we need to always be cognizant of that. But I think what we're trying to do here is look at very reasonable incomes and income ranges. And that's the exercise that Jonathan and I went through before we started. I'm not sure we can go through all 10 of these scenarios on a podcast, nor would you necessarily want us to, because it gets pretty boring with the numbers. But I think we can make a compelling case of where we came up with that amount. So that 25% for your mortgage or housing on after tax income, and still pursue financial independence and succeed. We looked at these amounts and we're coming up with savings rates that are very reasonable after looking at, again, none of what we're talking about here is deprivation. That is not what financial independence is about. And anybody who implies otherwise, I think, is just sorely mistaken. This is not about living a rice and beans life. It's about how can I live a standard middle-class life, but still succeed wildly. And I think that's where decisions come into play. Because, right, like if you just spent like everybody else around you, then of course you're going to be living paycheck to paycheck like everybody else around you. So clearly some decisions have to be made. I'm not arguing otherwise, but I don't think deprivation needs to come into this. So Jonathan, just even looking, it's funny because I can eyeball my own life on the path to FI here, which was basically a married filing joint, making about 100,000 combined as a family. And when you look at the monthly take home after taxes of 6,300, I think about 1,600 would be that 25%, right? That would be what you can reasonably pay for your housing. Mine was closer to like 12 or 1,300. So it was probably right in that 20% range. But I think somewhere around there. And that's what we hit on as, again, like we always kind of saw down the line, as I said 20 minutes ago, of what's your starting point on what I can quote unquote afford. And that was really critical to us is let's keep our housing under control. It's funny because I've never done this exercise. It really is pretty hilarious that like that was just a number that we felt very comfortable with, right? We were able to get a very nice 4-bedroom house in a good part of town in Richmond for, I think I've said it was $1,265, $1,265.
What I wanted to highlight there is your natural frugal nature allowed you to kind of blindly make a decision led by instinct that ended up producing a result that you look back on. But to be able to apply a guideline to why without actually knowing that, I didn't know, exactly what your mortgage payment was, what your income was, whatever, but be able to take a common sense rules for us. And then now, and we're going to take this table and we'll put it in the show notes for the episode because I found it informative as well. For those of you that already have a mortgage, it might be interesting to use this table as like a point of forensics just to say, oh, well, this is why we feel stressed, or, oh, this is why we actually are doing pretty well, even though a lot of other costs have actually gone up, pretty dramatically. But our savings rate, while maybe less than it was a year ago, is still actually doing pretty good. So we just threw out a term. I don't really like the 28% rule because I don't think it doesn't account for your state tax. It doesn't account for married or filing joint. It doesn't account for enough of your own life situation. Whereas your after-tax income, what you can actually make a choice around is a little bit more informative. And then applying these bands of your after-tax income, 25% really is the upper threshold. However, it's a continuum. And then we can experiment with that all the way up to 35% and then see how those numbers compare to the 28% rule in general. And also see at the other end, how comfortable are you going to be with what you're going to have left? Like, this was one decision made at one particular point in time, but assuming you never get a raise and income stays fixed, you're going to be kind of locked into these results. It's also worth pointing out that while the idea of house hacking is admirable, and I think a lot of us would theoretically like to do it, or we'd like to see our kids do it, are you actually going to do it? Like, I do know people, legitimately know people that are living for free. But out of the 100, 200, 300 contacts that I interact with on a pseudo regular basis, it's probably less than 5 or 4. It's not, most of us are not house hacking and living for free. Most of us are making a decision around how much we're going to spend on our housing. And it's a big decision that then locks us in, usually on average for 5 years, maybe 5 to 10 years before we maybe pick up and move somewhere else where it's a similar decision. So Brad, let me give this back to you. We have this table here. Now I know we're going to go through a couple different scenarios, and people can actually take a look at this, on their own as well, and dive into maybe a income bracket that more reflects their own personal scenario. But let's start with the $100,000 scenario, and then we can work our way towards one side or the other. $100,000 a year. How would these spending guidelines inform, what we could spend on a mortgage?
Yeah. So, I think very clearly, just in terms of, okay, if we're going to use that 25%, like I wanted to create just like a pseudo budget, and understanding that, again, as we always say, life is lumpy, things come up, you can't account for, but you can put in other, right, as an amount in a budget, because I think it's silly to put in nothing like that, just to line item everything, utilities, groceries, health expenses, transportation, and that's it, right? Like, you have to always assume there are additional things, but every single person listening to this could, in 5 minutes, mock up what we're going to talk about here for their own life. So, Jonathan, you created this form. I'm just going to go through it really simply. We had that married filing joint making $100,000 gross, but we said after taxes, that's $6,349 per month. So we'll say $6,350. And then we said 25%. We're going to have it as our rough guideline for your housing payment. Okay. So that amounts to $1,587. Again, just really simply, whatever amount you put for your income, you can just put a nice little simple formula in your Excel sheet as that amount times 0.25, right? So very, very simple. That's what's cool about using an Excel sheet or Google Sheets. You can do this really, really easily. So we have that in there. We just kind of mocked up random numbers, right? We just said, what's reasonable for utilities? I don't know, $150 a month. Groceries, $1,000 a month. That's for, maybe this family has some kids, right? $1,000 a month is pretty reasonable for your groceries, and then ancillary housing, random housing expenses, things you would buy at a grocery store, right? That to me, Jonathan, does not sound like deprivation at all. That sounds like real life, frankly. So we threw in a couple $100 for health insurance, health expenses, again, assuming these people are employed, so they're not covering the full burden of their healthcare. Obviously, this can differ depending on you and your life circumstances, but we threw in $200 just as a little mock-up here. Transportation, we assume $400, actually $550 with auto insurance, which maybe there's one car payment, maybe there's 2 small, tiny car payments and some auto insurance in there. That seems like a reasonable amount. Obviously, if you have multiple car payments, it's going to be significantly higher than that. So therefore, then maybe you can look at, okay, what does this mean for my savings rate, right? What does this mean for what I can, again, afford? And I use that word very intentionally. What can I afford for my mortgage or my housing expenses? So, other just things that would be in here, cell phone, internet and cable, maybe animals, pets, a couple $100 for those. And then for all 3 of those combined, then just other spending. Like I said, I think it's unrealistic to think there's not going to be other spending. Entertainment pops up, travel, whatever it may be. We put in $500 just as a random number here. And when I sum up all of those amounts, so let's take our mortgage out of it, right? So all the amount for everything else I just said, we came up to $2,700 per month in expenses. And then you add in that mortgage payment of $1,587, and that gets you to monthly expenses of about $4,300. Okay. So $4,300 in expenses per month. We said you're bringing in a little over $6,300 per month in income after taxes, right? So that actually leaves you a monthly savings amount of $2,000, which is really, really nice. And that actually boils down to a savings rate of about a third, about 33%, which is fantastic and right in line with what many people pursuing financial independence would be shooting for, right? I mean, we always use that mythical 50%, which is a wonderful goal. But I mean, this to me looks like a life that is very, very reasonable because, to be perfectly frank, this was my life for my entire working adult life. So I know for sure that this is reasonable. And it's pretty cool to look at this and say, okay, that's a 33% savings rate. And like you said, Jonathan, that 25% for your housing, again, based on after-tax money, not that 28% that we were talking about from gross income, which is obviously significantly higher. And again, that comes back to incentives, right? If you threw that amount in, your savings rate would actually drop down all the way down to 20%. So can you still afford that? Yes, you obviously can by definition. But would you rather a savings rate of 20% or 33%? And that's a legitimate question, actually, right? Because it gets back to goals. And I think that's where we started this actual exercise in numbers is really more qualitative based on your life and your goals. And that's open.
My only problem with a 28% rule would be, while it's easy to calculate, it separates you from the choices that you have to make on a month-to-month basis. There's too much space there. So as opposed to, this is what I have a choice, how I want to spend it each and every month. And when I make this decision, I'm potentially signing up for a 15 or 30-year commitment. How much is coming out of that pie on a month-to-month basis? And so, that 28% rule, while it's kind of a generic one you see out there, I really like this, 25% of your after-tax income. And think about it as a continuum. I mean, if 25 to 35% of the ranges, we could substitute 35% in there, which in this case, in that same scenario, would be a monthly mortgage of around $2,200, which is still less than that 28% rule.
But right, very close. So that's actually kind of a good rule of thumb, right? It's pretty darn close.
Yeah. And it depends on, what your goals are. Now let's all right, that's only half of it. So we could work our way through the different scenarios. But I think now that we start with this, so let's say we have this range, 25% of my after-tax income, I can feel pretty confident that I'm going to be able to hit my savings rate goals, right? So Brad, in your case, with this 25% on this $100,000 a year income, they were hitting a savings rate of around 32%. In actuality, if some of that savings is going into like pre-tax 401k, that number is actually going to be a little bit higher, because not only will they have more to save, but their tax rate is going to be less. So it kind of works for you on two factors, but we can make that decision later. But now we have this range in mind. And so now what we have to do is we have to translate that 25% of my after-tax income. That's kind of like what I would like to see as an upper threshold. But I also have this range in mind of 25% to 35%. And so 35% will put me at 2,200. I know if I were to go with that 35%, it's going to crush my savings rate. Right? Like, it's going to put a massive dent in my ability to get to the point where working is optional. It's going to set me back potentially a decade plus. If I want to do that, I just need to be aware of that. But that's kind of a range that I'm aware of when I take these numbers, and I now have to go figure out how much house I can afford. If you're making $100,000 a year, you probably feel like you're making a pretty decent income. So now how do we take that and we turn that into how much home can I afford? And we need to go find a mortgage calculator for this. And we need to keep in mind a few factors. One of those is that, when you're purchasing a home, your down payment can directly affect the interest rate that you're going to get, as well as whether or not you're going to have to pay something like property mortgage insurance or PMI. If you have at least 20% down on the house, then you don't need to worry about PMI. I went and looked to see what the PMI rates are right now. And it's like an extra type of insurance that protects the mortgage lender against the chance of you defaulting. And they tack on an extra somewhere between another 0.5% to 1.5%, somewhere in that range. So kind of a general rule of thumb is we're going to want to bring a big, healthy down payment in. Real estate agents like to see that as well, because they're able to take that to people that are selling their house and say, this is a serious buyer. They have their down payment ready to go. They're ready to move. They're really motivated, that type of thing. But we just talked about these other factors that are working against us. Homes seem to be going up in price. Interest rates are going up in price. So, we have to factor all of that into that. But now we have kind of a dollar amount in mind. So for our range, if the 25% in this case gives us some wiggle room of around $1,600, in this scenario, assuming that you're going to be bringing a 20% down payment, then, if you were to get a $300,000 house, 20% down payment would put you at $60,000 on a 30-year loan with the average interest rates right now being around 5.5%. Your total monthly payment would be about $1,600, $1,630. That's just like a general range. And you could see how for this couple, Brad, they would still be very competitive on their savings rate.
Yeah, I mean, that's right in there on the 25% that you said, right? I mean, we said it's 1,587. You just said it's about 1,600. And so, I mean, that is spot on right in there, which is super interesting. And again, like you said, there are different factors. What you put down, obviously, the more money you put down, the lower your monthly payment is, right? Assuming that the principal stays the same, but it's going to take you longer to save up. And then obviously there's opportunity cost of, hey, what could I have done with that money? Otherwise, there's always other factors. And I think, Jonathan, this goes way back to the beginning of the episode of like, nothing is one single factor. Life is multifactorial. That's just the way it is. And you have to always understand that. There's always a continuum, which is why we're not giving precise advice. We're giving guidelines on what we think. Like if we just had to do a back of the envelope calculation, and this always goes back to even like we're talking about real estate, right? So real estate investing, and we've had Chad Carson and Paula Pant and people like that on about what's just a rule of thumb, like that 1% rule of thumb for what's the rent that you should get based on the housing price. And it should be about 1% of the house price per month in rent. If you can get that or more, there's a high likelihood that's going to be a good real estate investment in terms of just a cash flowing property, not a speculative investment, but cash flowing property. So again, that's outside of what we're talking about here, obviously, Jonathan, but that sticks with me, right? That 1% rule sticks with me always of, oh, you mean this house in my neighborhood is renting for $2,000, but it sells for $400,000? Well, that doesn't work, right? That's like a 0.5% rule. That doesn't make any sense. So, okay, that's the starting place. So I think what comes away from this episode is that's a really interesting starting place for me to do my analysis of, I have a sense of what my monthly after-tax income is. Then obviously I could very simply figure out what 25% of that is. And that's my starting point for looking at what is a common sense spending guideline for me for my particular situation for housing. And now you always have to take things into account. Life, there's nuance, right? But to me, that's a really good starting point to walk away from an hour-long podcast with.
Assuming we're walking away, I agree. That's a great starting point.
I think that's a perfect way to walk away.
All right, guys. No, we are kind of wrapping up here, but there is a couple of points. It's a continuum, right? Like you don't have to spend 25%. And you don't have to get a 30-year mortgage, but like life is choices. And at some point, you got to figure out, are we going to be able to get into the home that we want to get into? And so you could be more conservative than this. Like, for instance, the 20% down payment is not dogmatic, but you need to recognize that if you're paying less than that, it's probably going to cost you a little bit extra in fees. And you might say, well, I don't, we want to get in faster. We can do a 3%, a 5%, a 10% down payment. We're not going to be able to get to 20. It's not like a hard and fast rule that you have to do that, but there is an incentive to get past that 20% loan to value. That way you can get that drop. So like, let's say you get into a house and then the home continues to appreciate and you've been there a period of time making a certain number of payments. I know individuals that did not have a 20% down payment, but they didn't have it wasn't 0%. It was 5, 6, 7, 10. But then the home appreciated and they were able to get that PMI removed just because the home appreciated over time. But really it comes down to like, how is that going to affect your payment? How is that going to affect your rate? That sort of thing. I know that on other personal finance shows, like I remember Dave Ramsey always used to say, it's a 20% down and it's the 15-year fixed mortgage, which I was never a big fan of personally. Although obviously, if you could keep that payment at below 25% of your after-tax income on a 15-year fix in a home that you're happy with, then that's incredible. And that's setting you up even further. And so, you definitely don't want to take out more mortgage than you want your need just because someone said you have to do a 30 or you have to do a 20% down. But you just want to make an educated decision based on, a combination of what it is that you want to get and then what your goals are. And your house should not rob you of your life goals. It really shouldn't. And you just need to put it in proper perspective. So I don't think this is a particularly restrictive framework, but it just kind of informs, are we setting ourselves up for a wonderful place to live that's going to be a blessing to our life, or is it going to be a curse and we're house poor for the next 10 years? And if you find yourself trending towards that 35% and beyond, you're going to get frustrated as you try to do other things because all of your and keep in mind, it's not just the house, right? It's the maintenance on the house. It's the renovation on the house. It's the landscaping on the house. And when you buy more house, all the other expenses that are associated with it go up as well. So just keep that in mind, how those are correlated. The last thing we wanted to come back to is just that interest rate scenario. And then also all right, that's fine. You gave me these numbers. They don't work for my area. There is nothing, even if houses I don't like or wouldn't want to live in don't meet the spending criteria. And I can imagine that statement resonates in certain parts of the country right now where the income has not kept up with the housing inflation. And it's very frustrating to look at, what is available. And in that case, Brad, I would just kind of ask you, should you sacrifice your life goals to just be able to squeeze into the house?
Yeah, Jonathan, that is a good question. And as you said, it's very personal, but I can give you my personal story, right? Which is very simply, I grew up in a high cost of living area, right? I grew up in Long Island, New York, and all our family and friends were there. And when my wife and I got married, we realized very quickly that we would always have to give up something to continue living there. And that was when you look back and it almost looks quaint what the housing prices were then, but between the housing prices and the taxes, it was an extraordinary amount of our income. And we simply couldn't have the life that we wanted because, again, we had an idea of what our goals were. Our goals at that point were we're going to have kids someday, and we want to have the option to have one of us stay home with those future kids. So that was something that was really important to us. Retiring or reaching financial independence well before 65 was something really important to us. Not giving up, being able to save and travel and save for kids' college at that time, right? All of these things were important. And what that led us to was moving to a lower cost of living area. So we moved to Richmond, Virginia about, I guess it's 16 years ago at this point, which is crazy. And that was a decision we made with eyes wide open. And obviously there was downside, right? Again, we left our family and our friends. And that is not an easy decision. No decision like that is ever easy. Obviously, that wasn't a requirement to reach financial independence, Jonathan, because we were both CPAs. We both could have kept working. We both would have made more income, et cetera. There were always these things, but that was something that we didn't want to give up in our particular lives. So yeah, we made that decision. And again, we moved to a wonderful part of the Richmond metro area. We had a really, really nice house, and it fit into, again, looking at the guidelines, which I only know today as opposed to 16 years ago, we were probably slightly under 20% of our monthly take-home pay on housing. And that helped supercharge us to reach financial independence literally decades earlier than would have been possible in our lives had we stayed on Long Island.
And so there's so many things that we can't control, right? We cannot control the interest rate at any particular point in time. It's frustrating to see that, potentially as you're looking to get a house, home prices are, surging. And at the same time, interest rates are surging, meaning, maybe a home that you want feels like it's out of reach in some scenarios. That's frustrating. But if we start with this anchor, we say, well, what allows us to still reach our goals? And then other things are actually shifting in your favor. When Brad made the choice to move from, the high cost of living area to Richmond, you really had to find a new job, and you had to find a job that was here. So you were dependent on the local job market for where you live. And unlike any other time in human history, right now, jobs are going remote. You can be living in quote unquote podunk town and you can stay there. There's so many towns, wonderful towns all across the country, raising wonderful people where it's not even that they want to leave, but if they want to get a job and a career and hype, they have to. There's no industry in local town that can sustain the next generation. That has long been a situation. You've seen a mass migration to various cities because of that. That is just unwound almost overnight, in the last year and a half. And for the first time, not only do you not need to move to the city at any point in time, but you can leave the city and go back to wherever you want. I think about scenarios like Millionaire Educator, where he happened to find this arbitrary town somewhere in Georgia, in rural Georgia, where there's no FICA charge in the town. It was something absurd like that. They had a little carve out in this particular city where the citizens there didn't have to pay any sort of FICA tax. And not only that, but they had all sorts of cards. I mean, he raves about it. We'll have to have him on. I need to clarify that. I'm not stating that as an absolute. You can message him directly. I remember him saying something. Brad has long since forgotten. So he's like, seriously?
I'm chuckling here because I'm not sure if that's true, but it very well might be. Your memory's better than mine.
But my point is, even if that's not true, you don't need to find the one city in the United States that doesn't charge a FICA tax. That's not the point. The point is, you can have a job in the high cost of living city, but live in a low cost of, and you never need to move there. You don't even need to go do the interview there. The interviews are done via Zoom these days. That's the world that we're living in. And it affects 90% of the jobs that are out there now. They are remote. They are, there are still jobs that are local. There are an insane number of jobs. Your job might be remote. Your current job, you're now working from home. Have you considered what that means, that you don't need to be there anymore? I have a couple new neighbors that realize that they're getting paid from a job in Boston, and they just realized they don't need to live there anymore. They can just be working here.
Yeah. I mean, it brings the concept of geo arbitrage that we've talked on the podcast for years. It brings it really to reality, a lot easier reality for people. Because to your point, Jonathan, in most cases prior to 2020, most people who were looking for geo arbitrage either needed to most likely find a new job in said town they were moving to, or they had to have some type of already pre-existing business of their own or some such that would enable them to do that. But I guess what you're saying now is this is a lot more practical for a broad swath of the population. And people don't generally think of that right away, right? It's, oh, yes, I can work remotely, which means I can work from my spare bedroom in the house that I'm living in that's 4 miles from my office. But I guess what you're saying is it doesn't matter if it's 4 miles, 400 miles, or 4,000 miles. It is still remote. So it's really, really interesting to consider that, as this might become much more viable for people in general. And like we always say, in the financial independence community, we see the world for how it is. We understand the rules of the game, and we look down the field and we make decisions that work for us and for our lives. So that's something that, again, even just having it in your sphere now of conceptual knowledge that, oh, you mean I could do that? Maybe somebody out there, I suspect many someone's out there listening to this, are going to say, oh, that might at least be worth investigating. And I don't think this was necessarily like our plan here on this episode, Jonathan, but like this is an interesting concept that I think a lot of people should start considering of, hey, is this possible? Is this something we want to do? Would this help further our goals? And that's always what this comes down to. Like, you don't have to move just for the sheer hell of it. I mean, nobody's arguing that, like, especially if you love your life where you live. I mean, but every decision or every non-decision is a decision ultimately, right? So you need to think through that. And hopefully this provided some food for thought for that potential decision.
All right, my friends, if you got value from today's episode, like, comment, subscribe. Is that what you do with podcasts? You like, comment, share, subscribe? Well, definitely subscribe. And if you are not yet on the FI Weekly, you should definitely do that. It's an incredible newsletter that Brad puts out every week. To join the newsletter, you can just go to ChooseFI.com and you'll see a subscribe button right there on the homepage, or you can go to ChooseFI.com/subscribe. It's a once a week handwritten email from Brad, arrives in your inbox every Tuesday, and it'll be a value add to your week. The fire is spreading, my friends. We'll see you next time as we continue to go down the road less traveled.